Okay, today, Mena, I would like to talk about trust distributions, kind of everything you need to know about running a family trust and how you decide to distribute any taxable income or capital gains that family trust might generate during the year.
Yeah, so the first thing you got to do when it comes to trust, it's important that you're actually across your trust deed. And if you can't sleep one night, they're a great read to put you to bed. But
Highly recommended.
exactly. But in every trust deed, there's basically it's your governing rules essentially as to what you got to do each year, whether you can categorize income into certain components or for example, you can have franked income or standard income or capital income. So, and then it tells you how you can actually distribute those funds. So some deeds would allow you to sort of stream certain types of income, such as, your capital gains to a beneficiary, and other deeds would not allow or provide that sort of flexibility. So it's important that you're actually across these kind of things, or I should say your accountant is across these things, so they can actually formulate a strategy as to how you should distribute your funds, whether it to be yourself or different family members or to a different entity altogether. So you need to really have a proper distribution strategy that you can implement effectively.
Now, the problem is that the ATO requires trusts to document how they're going to distribute the profit or taxable income, capital gains, whatever it is, the tax nature, tax results of that particular financial year, before the end of the financial year in what's called a trustee minute. And it's really just a document that records what the trustee's decision was with respect to those distributions. The problem, though, practically, is that that's quite difficult to do because the trust might be receiving dividends or other distributions from other trading entities, and it might be difficult to really ascertain overall taxation position of your family group at that particular time. So it might be actually hard to really work out how you want to distribute before the end of the financial year. And of course, Mena, I think probably the ATO instigated that rule to discourage people from tax planning.
Definitely.
Of course, but it's one thing to take into account or at least be aware of that is a legal requirement to have a distribution minute that is completed and signed before the end of the financial year. In one way, maybe it's if we want to look at the silver lining, in one way, maybe what it does is encourage people to engage in that tax planning process as an ongoing process, as opposed to something that you might do every 1 or 2 years.
And you really need to, I believe we spoke about it in a previous podcast with considerations as to how you're actually going to distribute the actual funds. Each year a trust can't retain any of its profits, otherwise you'll be paying an extremely exorbitant amount of tax. So it needs to distribute its funds to different beneficiaries, which you need to stipulate in that trustee minute that Stuart just mentioned. However, previously or historically, I should say, there used to be more flexibility around these distributions in that it could just generally be a paper distribution, no physical cash needed to be actually sent to the beneficiary. However, with recent guidance from the ATO, they've come out and basically said that that there needs to be a physical cash distribution. So you really need to be careful as to who you're selecting as your beneficiary, who you can actually trust with those funds, and what the strategy with those funds are.
Yeah, correct. So I think that's a really important consideration, because on paper we might sit down and go, oh, look, if we distribute to these people or this entity or whatever, that works out to equal the lowest tax rate. But from a practical perspective, people might not be comfortable doing that, having those conversations with those parties and so forth. So it really is, from a practical sense, an important consideration. And of course, if we're going to distribute money to what's called a corporate beneficiary, so a company, often a non-trading company, often people are attracted to doing that because then the profit is taxed at the company rate, which is either 25 or 30%, depending on its classification. And that's, of course, that tax rate can be attractive, particularly if you've got a lot of profit to distribute. But again, that physical cash has to transfer, and if it doesn't, then you've got a Div 7A loan as a result. The point of me saying that is really about the financial planning aspects of that. So if we are going to put the physical money into the company, what are we going to do with it? We just want to leave it in the bank account. We want to do something smart with it, as in invest it. If we're not going to put the physical cash in the company, and we set up a Div 7A loan, that's fine too. But then where does the money go, and how are we going to use it? So we're reducing non-deductible debt, a home loan, or, again, there's those financial planning considerations. So there's a lot to consider when running your own family trust, particularly around having a distribution strategy. And I guess what Mena and I would like to invite you to consider is looking at tax planning as an ongoing conversation rather than just an annual or a meeting every couple of years, or scrambling around after the financial year to get these sort of compliance matters sort of ticked off. If we can be at the front end of it, we can really consider all the options, and most importantly, or equally importantly, help you reduce your compliance risk. You don't want to invite the ATO into your life. You don't want to wave any red flags. If you can stay under the radar, make sure everything's done correctly. That's gonna be really the best way to live, I think. Okay, that's it for this week. Until next week, bye for now.